Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Jackie DiMonte, co-founder and general partner of Grid Capital. We talked about power laws, investing with conviction, how to help founders in their earliest stages, small funds versus big funds, and whether pre-seed valuations really are mental. I really enjoyed this one and hope you do as well. Jackie, thanks for coming on the show.
Thanks for having me.
I'm looking forward to it. I thought I'd start with your background being originally from Chicago. You went to Illinois. You went to University of Chicago. You're now in New York. And I guess my first question was, why did you betray the second city and move to New York?
Oh man, that's a good question. I did have a stopover in Austin, so it doesn't feel like such a slap in the face to my hometown. The short story about the Grid partnership, my partner Peter lives in Chicago, but is from the East Coast. And I'm obviously from Chicago and live in New York. And so whenever one of us is traveling to the other hometown, it's really, really going home. And so it is a nice excuse to get back. But the longer version of this story, I started my career in venture in Chicago. I moved to Austin for a combination of personal and professional reasons in January of 2020. So I looked like the smartest person in the world 3 or 4 months later and, sort of really got engrossed in the ecosystem there. And I think that's sort of what broke me loose from, Chicago as the hometown. Over time, I have more family. My sister's out in New York. My in-laws are on the East Coast. Moved to New York again, made sense personally and professionally. And certainly after COVID, the city's been bouncing back and really been an exciting place to be spending more time and really accessing both the talent on, sort of like the venture side, co-investors. We launched a fellowship program, but also the founders, that are building here. And so it's been nice to start to build these like deep communities in different places across the US. And, New York's the place I'm doing it now.
No, it's great. I mean, fair to say from our prior conversations that New York would probably be a better fit than SF as far as fitting with your thesis as well, right?
That's right. We focus broadly on technology serving the industrial sector. So manufacturing, construction, supply chain. And really, Chicago was at the root of that for a long time, right? It was the epicenter of logistics and logistics tech, supply chain. Obviously in Austin, construction and construction tech are really strong from a density and performance standpoint. And then when you think about sort of moving eastward, that, sort of like Atlanta up to New York corridor, a lot of logistics, you kind of cover that whole area, a lot of manufacturing. And so we start to see a lot of founders that are both involved in the tech sector, but having roots in industry really start to come from those geographies. I would say the one other place is probably LA is having its, sort of moment and sort of stepping into the sun in terms of manufacturing, but we certainly see those geographies overrepresented in what we do.
Cool. Totally different tangent, but I want to talk about portfolio construction and particularly that you've got a concentrated strategy. I dig that. I respect you doing it at pre-seed where that's a stiff cocktail. And I have a healthy respect for that. I tend to be more at seed. So I'm like, wow, okay, pre-seed, that's legit. What moments did you have in your investing journey that led you to be a concentrated investor?
Yeah, it's a great question. I love that you asked this because it made me reflect on, sort of the last 10 years really of both like why the focus area, why we think specialization matters, but then also why, concentration matters. And I think concentration is more a byproduct of having conviction, leading rounds, really having the capacity such that every investment we make matters to the fund and we matter to the founders that we back. And a lot of this heralds back to the fact that, 10 years ago or so, like when I started my venture career, pre-seed was really like friends and family, angel rounds, et cetera. And seed is sort of the pre-seed of today, right? Seed today, those companies are companies that are like 3 years into their journey. 10 years ago, it was like 18 months, maybe 24 months, right? So the actual maturity of what seed looks like has grown. So in many ways, our investing or sort of when Peter and I make an investment has not changed, right? It's more like the world has sort of evolved around us. But the reason why really concentration as a byproduct of leading matters was our experience very early on with what pre-seed rounds looked like 5 and 10 years ago, right? And a lot of times we call them party rounds. Sometimes they were accelerator, sort of driven rounds. But founders raising, 500, a million, $2 million rounds weren't really set up for success because one, the milestones weren't clear of what you had to do to raise the next round. Two, there was no investor that really felt ownership or buy-in in those rounds. If they were, sort of a lot of folks that had put in the same amount of capital, who do you turn to? Who is the person who really serves as a signal, who really invests, time along with their capital in the company? But the other product is, these companies can kind of take a while to figure out. When you invest at pre-seed, product market fit or line of sight into figuring out what product market fit looks like could be 2 months away or 2 years away, right? And that is why, this part of the asset class is both really fun, but also I think, Joe, what you're indicating is like kind of crazy. Like there's a little bit of muck you have to wade through. And so for us, being that partner that can say, okay, what are the specific experiments that we are running over what period of time? And then what do we have to show to make sure that we can, raise additional capital to support this company? For us, that is like a really strong way of investing at pre-seed and really, sort of shifts the odds of success for, sort of the companies that we invest in. And it's not that we are operators and we're actually changing the trajectory of these companies. It's more of we are someone that you can turn to say, okay, this is what we're hearing in the market. How do we think about what we have to do in order to maintain, sort of this momentum or get to that next milestone?
Yeah. Well, in the capital and the brand recognition of having someone step in and lead a firm with conviction, that alone goes a long way towards setting up for success for seed round.
I mean, hopefully, right? I mean, the thing that we do every day is participate in these processes. And so if we can sort of help clarify that for founders, that's probably the most meaningful thing we can really do.
Yeah. I think you made a good point on the go-to-market piece. Sometimes on podcasts, and I try to avoid this, but maybe it happens on the show too, people can talk about venture as if it's monolithic and they give advice for founders, forgetting that they're giving that advice very much like on a stage-specific basis. And part of the reason I bring that up, one of my founders today posted on Twitter about how they're looking at the biggest risks that stand between them and being huge and trying to make hires aligned with knocking those risks out from like biggest to smallest. It makes a lot of sense, but it makes sense in the framework of they already have product market fit and tons of draw from the market. The market is just kind of like sucking their product out of them. So there's all that flowing. And for them, I think that makes a lot of sense. But I think if someone who's a pre-seed founder reads that, they come away and they're like, oh, well, I kind of need to de-risk. And it's like, actually, you need to make sure you have a product that's built and you need to figure out how to sell this thing before you start worrying about de-risking. But what you said about the go-to-market piece definitely just resonated on that.
Yeah, I mean, de-risking is finding that thing. It looks very different once you've found it, to your point, right? It evolves very quickly.
Once you start working with founders, so the money's wired, all the paperwork signed, what are the first things that you dive into and start working with them on?
Yeah, I mean, I think it all goes back to how do we figure out what product market fit looks like? And what is really fun about the sectors that we invest in and the fact that we invest across a variety of business models is those metrics or those indicators are going to look different for every business. And so it's really sitting down and saying, okay, we have this thesis for what this business is going to become. We don't know that that's actually the case yet, right? I mean, everyone talks about how in pre-seed investing, it's about the team and then it's about the market, right? But the market matters in a way that you have to deliver something that the market really cares about. And so for us, we have a very strong hypothesis on the market and what product is going to best serve the market. But we have very little evidence, right, beyond conversations and indications, maybe some LOIs, maybe one or two contracts. But really, it's about how do we validate this hypothesis? And along the way, if we're getting data back that's telling us our hypothesis is inaccurate or it's not true, how do we then adjust and say, let's create a new hypothesis based on that information? And so it's really saying, okay, we think we have, identified this market segment, they have this problem, and we think our product is going to solve it in this way. And hopefully people will pay a lot of money for it, right? Or they will even pay money according to outcomes or SaaS, right? Like business model is even its own set of experiments today. So we think about that and then we say, like, what are the measurements or what is the feedback we're looking for that will sort of be a positive indication towards those hypotheses? And it's okay if they change, like that changes over time. But the worst thing that can happen at this sort of like pre-seed stage is you start to hide from some of that feedback versus addressing it head on. And so that's why it's so important to kind of like set those things from the onset so we can have the valid conversations of like, okay, like this isn't working. Let's figure it out. Or this is working. How do we invest, sort of stronger behind it?
Why pre-seed and not seed?
That's an unfair question. It's such a continuum, right?
That's true. It is
You
an
know,
unfair
I,
question.
I would say when I talk about pre-seed, and we actually talk about pre-seed as a continuum in terms of like what we invest in, you'll see
Mm,
me using this like text that's a pre/seed versus, pre-seed. It
that's
seems
good.
nuanced,
I
but
might
like
copy
there
that.
there is a continuum there. And for us, where we like investing is before it's obvious, right? Before you have product market fit and before you know how to start scaling. To me, there's, sort of in the early stage, three very distinct phases of a company's journey. There is pre product market fit. We think we're going to build something that the market cares about, but we have no idea yet. There's product market fit. We know we have something, we just don't yet have a business ready to scale yet. And then there is, sort of like, let's get ready to scale. And then you get into late stage. You start adding a bunch of different product lines, different offices, like all bets are off when you get to some of those growth stages. But for me, where I think we have, sort of the best odds of working with the best founders who are building the best companies is before we get to product market fit. And this is why we have a specialized fund is because one, founders want to work with folks who know what they are talking about, right? They don't have to like educate and re-educate you on the market every time you have a conversation, who can open up doors for customers, who can understand the incentives and potentially even hear feedback in a way that you're not hearing it that can, be additive to the business. And that is most useful at that pre-product market fit stage where you can have a real partnership with your, sort of pre-seed investors. Over time, these businesses become more and more obvious. And that's where different sets of skills and expertise can, really help the company. And that's just something where we don't have an edge in. And I'm sure, Joe, like you probably feel similar ways, right? Like when you get involved, like you are more of a like, I'm going to be in the muck with you versus I'm going to hold your toes to like, these different like metrics or lines. And so I do think it's a little bit of a continuum, but we can really create some advantages, in those early stages.
I want to come back to the pre-seed piece, but talking about industry, I've looked at some deals in manufacturing and supply chain, and something that stuck out to me is like the frenemy dynamics of the industry, where you can have typically, I'm looking at software, which I know you are as well,
Yeah.
but you'll have so many different individual verticals, and you have vertical players and you have horizontal platforms. And something that really stood out to me was the range of how you'll have feature overlap for companies that will compete on a feature, but they also will integrate. And as someone who is not deep in those spaces, I found it kind of hard to work with. I'm like, it was hard for me to tell like who is actually winning here and where this shakes out, like who partners, who acquires. And I'm curious, like someone outside looking in, like how do you think about those spaces as far as like the frenemy, dynamics between them and maybe exit opportunities and how they roll with that?
Yeah. First of all, I think the fact that you're asking this question is a really good signal as a more generalist investor. because it can be really hard to understand the market structures, the incentives, where you might have really strong founders that are all sort of competing against each other, right? And if you are someone who doesn't automatically have network connectivity into all of those places, sometimes you start to think you're the only one. A great example in sort of like recent history, and not even like these are still very early stage companies, but the logistics sector has become inundated with, sort of AI agents, co-pilots, et cetera, all for these different, sort of use cases. So let's take, a broker who has, a massive team of people, selling capacity or, booking and monitoring, sort of loads that are, sort of moving across the country. A lot of that work is manual. If you've seen pictures of these places, right, there's like 6 monitors up. You have a different system on each one. You're trying to compare, what capacity you have on the network to what your rate cards are, to what, sort of like what's coming in for you to react to. So a lot of really good uses of AI and ways to synthesize data and help, individual sales or ops people become more proactive, move quicker, sort of manage more capacity. And so for us, it feels very obvious, right? Like there is a lot of value that you can provide by having the ability to, sort of increase your volume without increasing, sort of headcount. Now, where we have a lot of challenge is everyone is taking an approach of, I have found the right entry point. Like when we talk about it internally, we talk about these control points, right? What are these use cases that have a very measurable high ROI in a very defined and hopefully short time to value? Well, a lot of these agents or applications do just that, right? They save you a lot of time, or they increase quality or output. And you can almost recognize these things, immediately because there's so much data, they become so robust so quickly. For us, even though we are specialists, we came to a conclusion of, well, which use case is the one, that's actually going to win out and create access to durability and scalability and the ability to do all of the use cases at once. And so for us, we, looked at a bunch of these companies, very impressive and capable people running them. And we ended up saying, you know what? We don't think this is a place for us and our fund to be participating because there's so much noise in the market. We think it will become a, sort of like customer acquisition bloodbath, right? And we're already seeing that from some folks in the market that are just like, there's a new person every week, every day reaching out to, sort of like sell me on scheduling or booking or rate cards or weather monitoring, et cetera. And so I think the question you asked, which is like, how do you sort through these feature overlap or, interconnected supply chains where you might sell into a supplier, there's a different person selling into a buyer, but eventually they might try to, like either overlap or compete. For us, it is if we have a really high level of confidence on what that control point is and how that gives you the credibility to sort of crowd out everyone else, that's where we want to spend time. If we don't have a clear hypothesis on that entry point being the entry point that gives you the advantage, then we don't know how to synthesize the market. And some of this is just based on the fact that we have a small fund, we invest a lot up front, we are like hand in hand with founders along for the ride. So if there's a lot of capital getting burned in pure acquisition battles, that's a really hard position for us in our fund. So this is like what is the venture world in general, but also some of it is just what works for us.
Do you have a founder archetype?
Great question.
You're on the nose founder.
Yeah, we have traditionally looked for folks from industry that have the ability to, sort of build a high growth tech company. Over the last couple of years, we've seen an influx of like unicorns at scale, industrial tech companies, and we're starting to see more folks that have both, like both high growth technology experience and really understand the incentives and insights of customers. We get really excited about those people. I would say the biggest quality we're looking for from like an archetype perspective is probably having the ability to create customer empathy because these can be such hard markets to sell into and trust is sort of everything here.
Are you agnostic on solo or multi-founder? Do you have preference?
No preference. I think it can work really well in different ways. I think if it is an incredible founding team, that's a superpower. If it is an incredible founder, that can also be a superpower. And so we take it one by one.
I was texting with Sonia from Snack before the show, and she's been on the show, and she's a Chicago OG investor herself. We were chatting, and she said to ask you about your thoughts on marketplaces as a model, which is her sweet spot, but also on vertical AI, and just get you rolling on those.
Oh, wow. That's a lot. That's a broad,
Yeah,
broad
yeah.
surface area. Oh, man. Look, I think there's nothing more powerful than network effects in this business and potentially in business in general. And I think the right marketplaces are very clear beneficiaries of that. I would say in industrials specifically, behavior change is hard, relationships are critical, and moving from being the supplier or the marketplace that you turn to when things are sort of like not going right in your regular channels versus the marketplace you turn to because it provides better service, access to better quality goods or services, et cetera, is really, really hard. And so I would say in general, like I love marketplaces for their potential. They are really, really hard when it comes down to how do you like really ingrain yourself in these markets. Does that make sense?
Yeah, it does.
Okay, vertical AI. So when Peter and I started Grid, it was, sort of during this advent of AI applications, which has really changed a lot of how we think about what we look for, what we invest in, and more specifically, like where durability or advantages come from. We had the benefit at our prior fund of investing in a company called Greenlight, which is a tech enabled services company that delivers permits to developers and works with municipalities and cities to be their private plan review. So they can both approve permits and, sort of get paid for delivering them. It was a very powerful hypothesis given a lot of companies were serving, just software, right, to monitor or better manage your permits. And the insight that we walked away from comparing those companies to at the time, what was sort of AI enabled, tech enabled services company was, people wanted the permits. They didn't really care as much about how the permits were getting managed. You wanted it delivered quickly. You wanted it delivered in a predictable amount of time. And that could translate directly into faster time to revenue if you are building, for example, a QSR restaurant, if you're building an apartment building. The sooner you can start, either selling the goods through the space or selling the space itself, the better it was for your bottom line. As we then moved into this AI era, where we started to see a lot of different business models, we started to see the ability to make services work happen at much higher, sort of margins. That led us to an orientation around two like categories or buckets of things that we find really interesting. One is your traditional core software systems, right? So your ERPs, your MESs, sort of these critical software applications that help you run your business and will own the data, own the workflow, and hopefully, automate a lot of that work over time. And then on the other hand, companies like Greenlight, which essentially remove entire functions from sort of like your team's plate and just deliver solutions for you. What has been really nice about having the clarity of those two different business models is anything that falls in the middle, we have to have a really good reason for why they have an advantage point to win. We talked about these like logistics agents and things like that. If you are a bolt on to a TMS, a transportation management system, are you in a position of strength and you're going to sort of like overtake a lot of that functionality, that interface, et cetera? Or are you in a position of weakness and a customer can just switch you out for another agent because they have their core TMS data? We have started to think about those types of companies in a very different lens than we had before.
Jenny Fielding, who, to get back to pre-seed, also
Yeah.
pre-seed investor, runs everywhere. She said on X recently that pre-seed valuations are mental. And I love the use of mental, which is very 90s. Feels like a great Wayne's World reference. Are you seeing that within the spaces you're in, or do you think that's a little more vertical centric?
Overall, the market is mental, but I think it is because the power law, which used to be a way that we described exits in venture, is very acutely being applied to fundraising as well.
Mm,
And so I think in general, when you look at like the round dynamics, there have always been these, sort of like legible consensus, name your like, hey, we all know this is a good team and like this is a market that is, interesting or like ready to adopt new things. Whenever you put together like two obvious categories, those founders raised quick, higher prices, etc. When you had maybe a less obvious team, but a really strong market, those companies would raise, but it would be more like, the average raise, right? And the difference between those two was not so big, right? It might have been like someone was raising on 20, another was raising on 5, right? At the pre-seed stage. I think the difference is today, like if you take that same 2 by 2, the difference is like 50 versus 10. And so you're seeing a much higher ceiling for what are those mental rounds than before, which shifts like the entire market completely. I think Peter Walker always has really great data on this stuff. And I think he was looking at, for $1 million round, the median round was at, I don't know, 13 or 10 or something like that. But the, top 5% round was done at like a 30. And so you start to see the vast majority of companies are raising in those, like single digits, maybe low teens. But then the ones that everyone talks about are the 30s, 50s, hundreds. And I think that's the stuff you remember. Are you seeing the same thing?
it's really situational. I agree with the power law piece where the hottest deals command wild valuations, but I think your median, there's not really a big jump. And for all the talk about it being competitive, if you look at dollar values, Crunchbase said August was the lowest single month for venture funding in like 8 years. Now, it's hard to read a lot into, a single month. You don't want to over extrapolate. And I think seed, the amount of money going into seed and angel and seed has been up. Top of my head, probably like a quarter, a third over the last year. If you look at like broader indices of broader collections of data. But yeah, it's very dispersed. And if you're one of these companies that has kind of vertical growth, like the line is not just up and to the right, but just up, you're going to raise at wild prices. But it's amusing that we're at this place now where there's open conversations about, well, are companies that are tripling revenue, are they worthy? Are they worth a VC's time? And I'm like, they are for me. Like,
Yeah.
by all means, give me
Yeah.
a call. Like, if you're one of those people, and I'm guessing you would be too. So it says a lot about the state of the market that there's this fascination with that extreme tail, when in reality, companies that have been doing, a triple, triple, double, double, like that historically has done great and probably will continue to do so. But investors love a good power law for sure.
What I would be curious to hear more folks is not just the pricing output, but the speed of processes that are happening. Because I think that's the other part is those very high priced rounds are happening nearly overnight, right? It's usually, I mean, proprietary deal flow is kind of BS, but there's like relationships or pre-marketing or, sort of something that gets a VC ready to be like, either we want to take this off the table or things are moving so fast, it gets bid up. I do wonder about, sort of the vast majority, what's going on with, how liquid the market is right now. Because my impression on the venture side is it's been a very hard fundraising environment. It's been hard for small funds, emerging managers. We had a lot of folks raise fund ones in 21, 22, 23 that I think pushed, subsequent raises out as far as they could, which means you're a little bit slower to deploy that last, 20% of your fund. And so I think there might be a slowness in the market too, which is not reflected in, the pricing. And, maybe there's still high prices, but it took folks 3 or 4 months to raise and, they grew throughout that fundraise period. Maybe that's another part that we don't talk about just because there's not as much data out there. But I think there is the mental, oh my gosh, everyone saw it in 1 or 2 days and then it got done versus the vast majority where you kind of are building these processes over time.
Curious, a data benchmarking piece. I saw Peter from Carta mentioned a stat that the median ARR for companies doing a Series A right now is 3 million. And if we go back in time 4-ish years, that was probably 1 million, which is an awfully hard and cruel jump in standards if you happen to raise a pre-seed round at that time and you really need to make 2 leaps forward. When you're talking to your pre-seed founders now, when you're talking to other seed investors, what are you hearing from at seed the expectations? And let's say, and just to put a little more meat on the bone with it, someone's done, an institutional pre-seed round that maybe you could call it seed, but the round in between that and, a 3 million ARR proper Series A, what kind of expectations are your founders hearing from investors that they need to be hitting to climb that next rung on the ladder?
I think at seed, it does not matter. I think you raise your seed round when you have the most momentum or what is the local maximum. And that is because seed rounds can still be raised on narrative versus performance. And they're kind of the last round you can do that. Maybe there's a post seed round, but usually that's hey, we're at 1 million ARR. We're not ready to raise a Series A. So we're going to raise, another $3 to $5 million. But I do think at this seed stage, it is, when does this company have the right momentum to raise another round, and from who, right? There are some companies you invest at the pre-seed stage and you're this next round is not going to be done by a multi-stage fund, right? It's not going to be a big seed or an A. It's going to be done by, someone who has exposure to this market or someone who likes marketplaces. There's different profiles of funds that are better fits for different companies at different points in time. And you have to understand where you position yourself in that market. I was having a conversation with a founder I work with, and one of our questions in the last couple of weeks was, should we have raised earlier? Because we have, sort of this backlog of contracts to implement right now. We need to hire more, sort of integration, implementation engineers. That's going to pull our revenue forward and really start to grow. But we also are how heavily should we be investing in this? The demand pull is coming almost in a way that we should have raised, a large seed or a Series A before this. But now it's do we allocate our time to fundraising or do we allocate our time to implementing? And I do think, given the demand in the market, you probably could have raised a seed round on much less evidence. And so I think there are ways to sequence the seed round that are either still based on narrative or are based on, traction and metrics. But it's kind of one or the other. As soon as you have things to start measuring, that's what you pay attention to.
What's a conventional view in venture you think is BS?
Oh, this is a conventional view that I perpetuate quite often, but always add some caveat. And that is, small funds are built to outperform, which I believe they are, and that is what we are built to do. But the converse of that is these large mega funds, multi-stage, are basically venture beta, right? That is the emerging manager's mantra, right? Is invest in me. I
might
fund,
have said something like that in the past.
my fund, I'm going to put myself, Peter and I together, we are going to put ourselves in the position such that if we hit an outlier, it really, really matters, right? We can hit a 5 to 10x fund if we get lucky and things go right. I think the conventional view that we would counter position against is those large funds, they have no shot of doing that, of outperforming. The dirty little secret is it's really hard to outperform. That's why it's called outperformance. And when you combine the fact that these funds are really, really good. Like, they don't just put themselves in the position where if they get lucky, they get really lucky. They kind of have to make it happen. And so when you consider the fact that like the best firms are the best firms for a reason, and then combine it with the fact that the top end of the market is getting so much higher, meaning, we went from the most valuable private, startup in the ZERP area was Stripe at 95 billion. Now it's OpenAI at 300, 500. I mean, it might be a privately held $1 trillion company, right? Like, the ceiling is getting so much higher, and you can start to see some of those, outperforming type returns happening at those later stages. And so I think as long as the floor doesn't fall out from us, which, there's the potential for that to happen as well. AI and this AI paradigm is still a new thing. But as long as that doesn't happen, you can start to see where these mega funds are performing, very strongly. And it's not just, sort of like buying the beta return from venture.
Jackie, this is really fun. I enjoyed it. It's always fun talking to you. I'd encourage anybody to follow Jackie's work online. It's great. She puts out a lot of great comments and data. So thanks for coming on the show.
Joe, this is fun. Thanks for having me.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups is not of sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.